All right, if you found this video, you are looking for some help on understanding some real estate abbreviations. I am here to help, and I hope to give you the tools that you need to be successful, to be able to digest the information that you are reading. My personal favorite way to borrow funds is through a Heloc. Heloc is an acronym for a home equity line of credit. Now, you already have to have a piece of property to be able to access a Heloc, but I love the Heloc because the money is made available to you with no payment attached to it. If you want to write a check from your Heloc account, you write that check on the spot. It's just as good as cash. And then about a month later, you will have a payment associated with whatever the amount of that draw has been. If you want to pay the Heloc off, it remains open until you close it out or until your term ends. It could be 5 years that you can take draws on your Heloc. That's pretty common. And a 10 to 15 year repayment schedule. So that is the Heloc loan. They'll usually lend you whatever your mortgage balance is. They'll take that and they'll give you the difference between that and the 80% mark of your fair market value. So the Heloc will not let you take every penny of what your house is worth, but they'll give you up to about 80% of the current fair market value in your home. If you own it free and clear, that's the number you're going to be able to borrow. The next term is a house hack. In simple terms, this is when you are using your primary residence as an investment property while you are living in it. Usually this describes a scenario where the purchaser is using a low down payment on a property, whether it's a single or multifamily, and then they're receiving rent or room and board payments from roommates or tenants. The goal is to buy a property where you can move in and be making money on, or at least live for free right off the bat. Then you keep the property, which will cash flow better once you've moved out and rented out the space that you were occupying. I think this is the best way to get started as a real estate investor, and before the term was a term, I house hacked into my first property. If I had to start all over again, or even if I just moved to a new location that I was not 100% familiar with, I would house hack to get started. The next valuable term to know is the 1% rule. This is my favorite quick and easy way to determine if a residential deal deserves my attention or not. The 1% rule says a good investment brings back at least 1% of the total investment in rent each month. So if a $200,000 property rents for $2,000 a month, it barely achieves the 1% rule. Usually, even if a home appears to be move-in ready, there's something that I'm going to spend money on before I put a tenant in there. I'd rather deal with the upcoming expenses head-on before a tenant is there, because it's much easier to get work done on an empty unit, and because you can't always rely on a tenant to tell you when problems occur. Other reasons as well, but bottom line is that your total investment needs to be used in the calculation, not just the purchase price. So the 1% rule is calculating ROI, which is return on investment. I don't know if you needed that, but while I'm breaking down any acronyms and abbreviations, this would be the video in which I should break that down. My first calculation to determine my ROI is the 1% rule. If the property exceeds that calculation, I dig deeper into either the COCR or the CAP. COCR is cash on cash return, which is a very useful way to gauge your investment. You simply take 1 year worth of expected rents and divide it by the total amount of cash you'll have put into the deal. You'll end up with a decimal which is representative of your percentage rate of return. If I am using financing, I like to see at least a 20% cash on cash return, but all factors and variables are considered on any opportunity, so there may be cases where I wouldn't touch it at a 30% return and cases where I'd be racing to secure a 15% cash on cash return. The cap rate that I mentioned, this is used when assessing commercial deals. The higher the cap rate, the higher the profit. When calculating the cap rate, you need to get down to the net income rather than the gross income. So you need to get the actual expenses or estimate them yourself. Once you have the net income, you divide that number by the purchase price and convert that decimal into your percentage. A strong cap rate would be a 10, but with the market being favorable to the seller at the moment, the deals on market are typically between 5 and 7. The BUR Method. The BUR Method is where you buy, rehab, rent, refinance, and repeat that process. Obviously there's some layers here, but this is an amazing way to invest in real estate, and it can be applied to any property type. The goal is to purchase a property at a discount, usually due to the need for improvements. Then you make those improvements, get a renter into the property, and as soon as possible after that, you do a cash out refinance on the property. It is typical to be able to pull out 80% of the appraised value, so the goal is to be all in with your purchase and rehab costs at or under 80% of that fully improved fair market value. That value is often referred to by investors as the ARV, which is after repaired value. This allows you to get back every penny you've invested and potentially make a great profit as well that you can put towards the next project. Of course, the rental side needs to hit the numbers that you're looking for as well, because you want to have positive cash flow every month. So if this is done perfectly, you could be growing your cash on hand, your portfolio, and your monthly income without leaving anything invested into any of the properties that you own. $0 invested or a negative amount invested because you got a payday when you did your refinance means your return on that property is infinite. And that's just insane, but it's real and it's amazing. Those are the most useful terms to understand when it comes to investing in real estate, especially if you're new to this. There are other abbreviations, initialisms, and acronyms used, but the ones that I have listed out seem to me to be the best ones to know in and out. If you're new to this and will be talking with a lender, here's a couple bonuses for you so you don't get tripped up. DTI is debt to income, and this is what your conventional mortgage lender will focus on along with your credit score when they run their risk calculations to determine whether you are someone they want to lend to or not. It is typical for a lender to require that your debts, including your mortgage payment, do not exceed 40 to 50% of your income. Some lenders are doing stated income loans for borrowers with great credit, while private lenders are issuing loans based on the deal. The private money sector comes with many variables, so do your due diligence if you find yourself navigating those waters. PITI is your principal, interest, taxes, and insurance, which makes up your total mortgage payment. PMI or MIP, which is private mortgage insurance or mortgage insurance premium, is also included in this calculation. PMI and MIP are the same thing. This is a premium insurance attached to your loan that you pay on monthly in lieu of coming up with a larger down payment. Your credit score, your DTI, your purchase price, and your down payment amount will all have an effect on what this will cost you each month. My tip for you, if you feel that it is unlikely for you to keep the house that you're buying for 10 years or more, you will likely save money by opting to do lender-paid PMI rather than paying it yourself. Ask your lender to run the scenario if this is an option that you are weighing out so that you can make a sound decision. That's all I have for you in this video because I wanted to keep it brief, but if you'd like to get more detail on these topics and dive deeper into all things real estate, please subscribe. I'm going to continue to provide simple information with valuable insight to help you attain your goals, so make it easy by turning on the alerts, and I'll see you soon.